Mark Perchtold of OMBA. Good to be talking to you again, Mark, as we head into the festive season. You are based in London, but you've just been to South Africa. When you come here, do you get a sense or a better sense on each successive visit from how people are viewing A, the future of South Africa, and B, the future of their investments?
Definitely. It seems to have been consistent though over the last couple of years. There's obviously somewhat of a negative tone to some degree relating to obviously energy and what's going on with Eskom. Maybe more recently in the last year, there's been a bit more discussion around water and water infrastructure. And then your sort of same old concerns that have existed for ages. But no, the mood doesn't seem to have worsened at all in the last year or so. It seems fairly consistent.
Which is incredible if you think about the load shedding we have at the moment. I think we're on level 5 or level 6, 3 times a day. Electricity's off. It's we're such a resilient people, South Africans.
It's actually fascinating because our first few trips back after COVID, having not been for a while, I would be in meetings in a room in an office, and the lights would go out and the air conditioning would go off, and people just carried on like nothing was wrong, and they sort of don't worry, the generator will kick in or the UPS will kick in. So people have definitely started to make more sort of contingency plans, and I guess over time, more and more people will move off the grid if they can afford to do so. I was staying with a friend over the weekend, and we were watching the football at his house on the Saturday night, and electricity went off, and everything just stayed on like absolutely normally. And he'd obviously connected his house with battery packs and solar and the rest. So I think if you can afford to do that, that's great. And I think the challenge will be for maybe small and medium enterprises if they've got a manufacturing facility. I think obviously the load shedding has been distributed differently across the grid and in different areas. So not everyone suffers to the same degree, but it's certainly a worry. And I think South Africa is resilient, and people will make a plan. Hopefully, Eskom come right, and energy delivery improves. But households and businesses are making alternative plans, and I think that hopefully continues. So let's be optimistic. I think if you look forward 5 years, I think people they know they've got to make a plan. So that's happening now, if you can afford to do so, and I think it'll be okay. I, I I'm reasonably optimistic because I actually saw it in practice, where you'd be in stage 4, stage 5, and you'd be out for 4 hours, and people had a plan in place. But if you're a household and you're working from home in this new regime of work from home more frequently and your internet goes down for 4 hours, I don't think that's necessarily good for the economy. So I think there's still a lot to be done.
Not good for your bank balance either. It's very difficult to do business when you're off grid or offline for 4 hours. But how's this affecting the appetite for Omba's products, given that you guys invest globally?
I think it's not new that people want to invest more abroad. So that's something that people have been doing for decades. From a South African perspective. But I do think there's definitely more interest in accessing offshore solutions. Exchange control has allowed people to get some money out more easily. The million rand or 10 million rand allowances allow people to quickly externalize money. You see a lot of people still want to keep their money in a wrapper structure, which is often very tax efficient in South Africa. But then within that wrap structure, they will move into offshore solutions. So there's definitely been a positive trend in the last several years of people externalizing capital. But it's not something new. People have always wanted to do so. And I guess it also depends on your excess disposable income and savings. How much can you afford to take outside South Africa? The rand has, remained reasonably resilient over the last sort of several decades. If you look at the deposit rate you earn in ZAR versus the deposit rate you would have earned overseas in certainly the last decade, you compensated to a large degree by higher, fixed income and domestic deposit rates. So you're not that much worse off than one would think over a long period of time because you are paid more in ZAR. But then you've obviously got concentration risk to one country and one currency. And I think that's why people also want to diversify.
Mm. When we have a look, we're going into the festive season now, and we often people, it's the one time of the year when you switch off. You don't really want to be bothered by looking at what your investment's done on a day to day basis. How are you seeing, first of all, the best way to structure yourself with the next 2, 3, 4 weeks in mind? And then perhaps we can extrapolate that into 2023. Already, I'm seeing some people predicting it's going to be a terrible year. Other people say it's going to be a fantastic year. So there's a lot of confusion about how you should be positioning yourself for the very short term, and then for the, shall we call it, the medium term of 2023.
Yeah, I mean, we're more long-term investors than short-term investors, so we're not trying to time the market over a month or a quarter. However, having said that, if one was trying to do that, I think it's likely we have a correction in the first half of next year as you get headlines of recession and increasing unemployment and poor economic data coming out. So it wouldn't surprise me if you have a correction in the first half. And that correction will be caused by company earnings being weaker, GDP numbers printing lower. I think inflation it has started to come in and will continue to do so, which is a positive. And there'll be a point in time where the Federal Reserve, being the major central bank of the world, do pivot to more dovish rhetoric. And I think at that point it'll be when the economy is weaker that you've seen unemployment start to rise and inflation already start to drop, and that will probably be the impetus for the next cycle potentially. But I think investors should expect volatility in the first half for sure, as you see weak data come out. And in the second half of next year, I'm more optimistic. I think by that stage, you would have had a lot of the bad news behind us. Hopefully, we've made more progress relating to the Russia Ukraine situation. You've already started to see energy markets rebalance, supply chains are working again. And so inflation is coming in. There are markets which will feel more pain. For example, here in the UK, I think as you would have read, the recent unions and sort of labor unrest and strikes taking place throughout the month of December, could cause some type of wage inflation spiral. I hope that's not the case. So, an economy like the UK might struggle to bring in inflation to the same degree as perhaps the US, where you have a more flexible labor force. So it's going to be quite different around the world as you see the data come out. But investors should certainly expect some more volatility in the first half. This has sort of been a very strong Q4 thus far, and it's been a nice respite after a very brutal first 9 months of the year. But valuations are more attractive if investors have a 10-year time frame, and you look at based on where multiples are now, broadly speaking across major markets, valuations are more attractive and one should begin building that long-term portfolio. But keep in mind that you may get a better entry point in the first half. So we're positioning more for the long term and trying to think about owning quality sectors and maybe more quality regions and countries in our portfolio construction. And it's difficult. Do you cut your equity exposure outright, thinking there's going to be a first half correction? And how deep would that correction be? Is it going to be a 10% sell off, or will we make new lows in the market? These cycles do tend to run over a longer period of time. Everyone looks at calendar year, but if you go back to the GFC, I mean, COVID sell off was effectively 1 month, and then markets rebounded very quickly. Whereas for the global financial crisis, it started in '07, and the lows were only reached in March '09. So it sort of spanned over 3 calendar year periods, with '08 being the worst of those. So it could drag on for long, but we don't think the world is in as bad a place as we saw during the GFC, from a systemic risk perspective.
So, how do you position yourself now to be able to have a good holiday, sleep easy, and no matter what happens in the next 6 to 9 months, you will be in a place where actually, and I think the last time that we caught up a month ago, you said, just diversify yourself and don't get yourself into high risk positions where you lose sleep over it. And that's kind of got to be the right way for investing. But how are you seeing that right now?
I mean, absolutely. Diversification is at the core of how we think about investing for the long term. So having a diverse portfolio, both in terms of asset class, so fixed income and equity, but then also from a country, regional, and sectoral perspective is very important. And then the key for us is avoiding risky, positions and sectors and countries where multiples are still very extended. If you're a stock picker, which we're not a stock picker, we use ETFs to build our portfolios. But if you were a stock picker, you would want to avoid loss-making businesses, highly leveraged businesses, companies with weak balance sheets, where maybe revenue's been growing nicely and revenue started to recover, but you've still never turned a profit as a business, I would completely avoid businesses of that nature. And you're starting to see consolidation in certain sectors. I was reading on the weekend about consolidation in the food delivery market, for example, where a lot of these companies have to do extra funding rounds because they've burned through all their cash. They've been growing revenue and number of customers fantastically, but they've just burnt through all the cash, and they're unable to fund themselves at the same valuation as the previous funding round. And so you're starting to see consolidation where bigger players take out smaller players that are struggling. And so I think you'll see in many parts of the market consolidation amongst often weaker firms where they're better off coming together. I think you'll see, lots of layoffs, and there will be a sort of the venture capital and early stage investing market will suffer. But blue chip, large cap companies that continue to generate revenue and profits and trade at more attractive valuations over the long term, one would be okay. Of course, there could be multiple compression as markets sell off and there's a broad sell off in equity, but fundamentally your business won't go to zero and go bust. So it would be avoidance of that. And anything with too much leverage, which is a simple thing to avoid. Companies that have borrowed too much money and now with higher interest rates won't necessarily be able to fund themselves, and companies that have never turned a profit. So they need to keep going back to investors, whether that's debt or equity markets for funding. They're also potentially in big trouble as we go through the next year. And you're starting to see a lot of tech firms increase the number of layoffs. Startup firms, similarly, there are hiring freezes in financial services. You're seeing cuts to headcount or headcount freezes. Compensation and bonuses might also be cut in order to indirectly make employees a bit more disillusioned and therefore maybe change career and want to leave the job because they were hoping for all this upside. So I think employment data over the next 12 months will be very interesting to watch as you're starting to see these headlines of various sectors cutting jobs.
You had an interesting point there about the food delivery sector. That is an area where Naspers plays quite aggressively. Naspers being a big stock on the South African market and one that is closely followed by South African investors. It also has exposure to China, where Tencent has had a fantastic few months. It's gone from 200 Hong Kong dollars a share to over 300 Hong Kong dollars a share in the last couple of months. So that's helped the Naspers share price. But how are you seeing, if we leave food delivery out of it, because that does seem to be a bull factor for Naspers, how are you seeing the Chinese story with COVID now, the restrictions on COVID seemingly not quite as tight as they were a little while ago?
Yeah, I think China's obviously had a rough patch over certainly the last 12 and 24 months from a regulatory and policy perspective. A lot of announcements they've made have spooked the markets, and so China's been very out of favor. And obviously, the West-East rhetoric geopolitically has put pressure on China. But China, is a very, very large economy, and just to remind you, we're quite optimistic China long term, and so we've had a slight overweight to China in our portfolios. And that started to bear fruit. Chinese company earnings are much stronger and more resilient than many of the Western markets. So if you look at actual earnings generated by Chinese businesses, and those have obviously been impacted to some degree by the zero COVID policy, which now is starting to reverse. And I would say that's a very optimistic signal for China. So I think China is also less correlated to the rest of the world, and from an equity market perspective, if you look at correlation tables across major markets, China is one of the least correlated. So there's a lot happening in domestic China that will be good for China. And a big, sort of overhang over the last year has been the zero COVID policy, which we think will continue to be relaxed over the coming year, and as they roll out vaccines across China. So you could very quickly paint a positive story relating to China, but it's always going to have this overhang of an east-west geopolitical rhetoric, regulation that is announced in China. One should invest in China with a view that expect volatility. You never know what headline's going to hit the tape relating to policy or a west-east conversation. And so we invest in China long term because valuations are attractive. The companies there make money. We think zero COVID continues to get reversed, and so we're net optimistic on China.
What about Europe? This is a part of the world that Sean Pesh, for instance, was saying is very, very cheap right now. I was reading something in the Financial Times where they were saying that the European energy companies are really cheap and that American investors, relative to their own energy companies, are now looking to Europe as well. What's your view there?
Well, it's interesting you ask because two of the trades we've done in the last year have been to increase our way to Europe. So we've held European value ETF as one of our core positions in Europe, and we recently, not say took profit, but on a relative basis, it did very well versus say the stock 600 index. And so we moved out of that in favor of European autos, which trade very cheaply. The sector has been completely beaten up because buying a car is a big ticket item. It's not like replacing your kettle or your fridge, which you need every day and you will replace it if it breaks. A car is maybe more of a luxury big ticket expenditure. And so in a recession, people are unlikely to buy new cars, and so the sector is trading at very low multiples. And we think one should begin an early rotation into the European auto sector, which we've done. Similarly, the DAX index, the DAX 40, blue chip multinational companies in the DAX 40, many of which will suffer because of higher energy costs and caps on energy use that's currently taking place in Europe. So there is some earnings pain to be felt by many of these corporations. But again, it's a blue chip index of blue chip companies and trading very cheaply. So we've started to move a bit more into the DAX 40 as well. So I'd concur with Sean on Europe offering value. But Europe has other structural issues. The decision making is more complex in the EU. There's a lot more, as people know, bureaucracy in getting things done. There's the energy crisis, which is on its doorstep and making input costs higher. There's, labor unions are more powerful. There's more protection for employees. So you have a less flexible labor force. You have aging populations. There are concerns, but if you go back to the fundamentals of investing, if companies are generating profit and the multiple of that profit is reasonably low, over time you get rewarded as an investor. So it's trading off valuation versus growth. I think growth may not be that great, but valuations are very attractive. And you've still got the overhang of the Russia-Ukraine story in Europe. And I think, it could drag on for years. Who knows? But, our view has always been this is not going to be solved in 6 months. This is going to be solved in several years. And so our view has been accept that it'll be solved over several years. But markets are quite efficient in adjusting, and you're starting to see that now in Europe.
So, Mark, just to summarize everything, diversify. There are pockets, as you've mentioned, Europe, perhaps China as well, but just know there will be volatility and it is going to be a long term bet. When you say long term, what is your typical time horizon?
Most of our investors allocate capital to us for north of 3 years and definitely longer term. Many of them are investing for the next generation, or they're investing for their retirement or their children's university tuition abroad if they want to send their kids overseas. So the reason for an investor to invest offshore is often, they've got a longer term expenditure, whether that's retirement, kids' tertiary education, or passing on to the next generation. And so we guide our investors to not think in quarterly or monthly periods, but certainly 3 to 5 year periods. And so our view is we want to allocate our tactical views are typically 6 to 18 months. So even when we do something tactically, it's not with a single quarter in mind. It's that over the next 6 to 18 months, we think our view will pan out. So long term is certainly north of 3 years, ideally north of 5 years.
And the way that you positioned right now?
So we've started to move a bit more into Europe and to the US from some of our Asia Pacific exposure. We've kept our slight overweight to China in place, which has obviously helped us a lot in the last quarter. We've been underweight US technology last year, and during the course of this year, starting in the first half of this year, we've begun to increase our large cap US tech exposure. So we've got a global portfolio. It's about 50% Americas, and then the other 50% is split more or less equally between APAC and EMEA, with slight nuances therein. As I mentioned, European autos, the DAX started to increase that. We had an overweight to FTSE 100. We've removed that overweight because we're concerned about a lot of the UK. Although FTSE 100 earnings are 70% non-UK, does tend to get dragged down with the sentiment towards the UK. We had an overweight to Latin America. Latin America has done very well this year. Brazil and Mexico, etc., are energy exporting countries. Their markets have been quite resilient. in fact, when we removed our position, it was up for the year. So we've removed that LATAM exposure. We'd maybe look to re-enter that. So one can be quite nimble within a global geographic or sectoral view in the course of a year. And we think just keeping that global portfolio diversified is at the key, but being clever about some of the sectors you want to own.
Mark Perchtold is a founding director of OMBA Advisory and Investments, and I'm Alec Hogg from BizNews.com.
Thanks, Alec.